As we head into the new trading week, the markets are currently closed. The last session for Rezolve AI PLC, trading under the ticker RZLV, concluded on Friday, October 31st, 2025. The stock finished the day at 4.29 USD, a solid move upwards of 4.89%. Activity continued after the bell, with after-hours trading pushing the price slightly higher to 4.33 USD, an increase of just under 1%. On the surface, this looks like a healthy, green day for a small-cap tech stock. But that single day's chart, or even the 52-week range showing a low of 1.07 and a high of 8.45, does not even begin to tell the real story. The expectation many have for RZLV is that it's just another speculative company chasing the artificial intelligence trend. The reality is that this stock has become one of the most complex and fascinating battlegrounds on the entire NASDAQ, pitting a scathing short seller report and active class action lawsuits against a sudden and massive influx of new buying from the world's largest institutional investors. The common belief, and what many retail traders on forums like Reddit and X are discussing, is that Rezolve AI is a high-potential, high-risk play. You see the name Rezolve AI. You hear about its strategic partnerships with giants like Microsoft and Google, and you see a fresh analyst price target that was just raised a few days ago to an average of 10.79 USD. The expectation is that this could be a ground floor opportunity, but that expectation is immediately challenged by the intense negative sentiment from another camp. The reality is that RZLV is currently fighting for its reputation. This isn't just a simple story of growth versus value. It's a story of survival, litigation, and a profound disagreement in the market about what this company even is. The central conflict is not whether its tech is good, but whether its business is real. Let's first address the storm that has been brewing. The entire narrative for RZLV was fractured in late September when a short seller, Fuzzy Panda Research, published a scathing report. This report was not a mild critique, it was a full frontal assault. The allegations claimed that Rezolve AI is essentially faking its annual recurring revenue by acquiring failing startups with declining revenue. The report went further, alleging that former employees were shocked because, in their view, the company had no use case and no live example of its AI, calling it just a dream. The short seller's thesis is that this company, which was formerly a mobile-related business, simply decided to pivot its branding to AI to capitalize on the market trend. It also claims those highly touted partnerships with Microsoft and Google are one-sided arrangements that provide little real benefit to RZLV. This short report was, as you can imagine, explosive. It immediately triggered a series of investigations from multiple law firms, including Shaw and Pomerantz, who are now seeking to build class action lawsuits on behalf of investors who may have lost funds. The claims center on whether the company issued false or misleading statements to the public. This is the core of the bear thesis, and it's a powerful one. It has created a cloud of uncertainty that hangs over the stock every single day. As if that weren't enough, the company is also entangled in separate, complex litigation with investment firms Yorkville and JBAAM. This dispute is over a staggering $1 billion Bitcoin financing agreement that ultimately failed. The plaintiffs argue Rezolve didn't use its reasonable best efforts to close the deal, while Rezolve's defense is that no funds or shares ever changed hands, so no actual damages occurred. This lawsuit adds a bizarre and chaotic layer to the company's story, suggesting a management style that is, at the very least, unconventional. This brings us to the short-selling activity itself, which is a mandatory piece of this puzzle. The data from mid-October shows about 11.55 million shares of RZLV are currently held short. This represents about 7.73% of the public float. Now, 7.73% is significant. It's not the 30 or 40% you see in extreme squeeze plays, but it is a clear indicator of a substantial, committed group of traders betting on the price to fall. But the most telling number isn't the short interest, it's the cost to borrow. The short borrow fee rate for RZLV has recently been hovering over 11%. To put that in perspective, a typical easy-to-borrow stock might have a rate of less than 1%. An 11% fee is expensive.
It means that short sellers are paying a high premium to maintain their negative bets, indicating a high demand for shares to short. For investors, this is actionable information. You can find short interest data on platforms like Fintel or even on the official NASDAQ website for the stock. What you need to watch is that borrow fee rate. If that 11% rate starts to spike, say to 30, 50, or even 100%, it signals that the supply of shares available to short is drying up and shorts are becoming desperate. This is the kind of pressure that can lead to a rapid upward price movement, often called a short squeeze. What's your take on the rising borrow cost for RZLV? Is it smart money positioning for a collapse, or are shorts getting desperate? The days to cover metric is currently low, around 1.34 days. This means that based on average volume, it would only take shorts a little over a day to buy back all their positions. This makes a sustained, drawn-out squeeze less likely, and it's a warning against blindly chasing the stock expecting a massive squeeze. The risks of playing that game are incredibly high. But this entire bear case, as compelling as it is, now faces its own serious contradiction. If this company is a dream built on faked revenue and failing acquisitions, why are the world's largest, most sophisticated, and most risk-averse financial institutions suddenly buying millions of shares? This is the bull case, and it is just as powerful as the bear case. In the last quarter, the number of funds holding RZLV increased by over 117%. The total number of shares held by these institutions grew by an astonishing 442% to over 13.6 million shares. We are not talking about small hedge funds. We are talking about BlackRock, which now holds over 4.7 million shares. We are talking about Geode Capital Management, Vanguard, and State Street, all of whom initiated or added significantly to their positions. Market-making and trading firms like Jane Street Group and Susquehanna are also on the books. This creates the central dilemma for every investor looking at RZLV. Who is right? A short seller research firm that profits from the stock's decline, or the risk management departments at BlackRock and Vanguard? Those institutions have entire teams dedicated to due diligence. They do not invest millions of dollars based on a press release. They are buying this stock after the short report was published. This is the expectation versus reality framework in its purest form. The expectation is that institutions would flee a company accused of fraud. The reality is that they are running towards it. The company, for its part, categorically rejects the Fuzzy Panda report, calling it misleading, inaccurate, and a selective misrepresentation of its audited financials and SEC filings. The bull case rests on the idea that these short reports and lawsuits are just noise intended to shake out weak hands while the smart institutional clients build their positions. So, what does Rezolve AI actually do? According to the company, its business is very real. It is a UK-based firm that has developed an AI-powered platform for mobile commerce. Its core product is the Brain Suite, which includes a proprietary large language model called Brain Power. This platform is designed to help retailers and brands engage with consumers, offering things like a new visual search feature where a user can take a picture of an item and be taken directly to a dialogue-like shopping experience. Beyond retail, the company also offers a brain assistant for enterprise clients, designed to automate internal IT and HR support requests by integrating with platforms like Microsoft Teams and Slack. The company's monetization model is based on subscriptions and transaction fees from this platform. The company's financials, however, paint the picture of an early-stage, high-growth, high-burn company. The operating margins are, as you would expect, deeply negative. The ROA is listed at a staggering negative 872%. This is a company that is burning cash to achieve its goals. This financial reality is precisely why the company has been raising so much capital. It closed a $200 million private placement in September. This followed a $50 million private placement back in July, where it sold shares to institutional investors at a price of $2.50 USD. This 2.50 price is a key level to watch, as it represents a floor where major investors recently found value. This brings us to the future outlook. RZLV is not an investment for the faint of heart. It is a binary bet on two competing realities. In the first scenario, the bear case is correct. The short sellers at Fuzzy Panda are right, the lawsuits gain traction, the partnerships with Microsoft and Google are revealed to be superficial, and the institutional buying from BlackRock and Vanguard was a rare, colossal miscalculation. In this scenario, the company's cash burn rate becomes its undoing, and the 2.50 placement price is not a floor, but a ceiling on its way back down. In the second scenario, the bull case prevails. The short report is proven to be the misleading document the company claims it is, the lawsuits are dismissed as opportunistic noise, the institutional buying is seen in hindsight as the smart indicator that correctly identified a company on the verge of validating its technology. The brain suite gains traction, the company's revenue grows, and it moves towards the 10.79 average analyst price target and beyond. Everything depends on execution and the company's ability to survive this intense public scrutiny. Looking at this setup, comment below what you think is the bigger story, the Fuzzy Panda short report or the new institutional buying from BlackRock. What investors must watch next is simple. The next earnings report will be critical. The market will be looking for any hard data on revenue, user growth, and most importantly, the company's cash position. Any updates on the multiple legal battles will also cause significant volatility. And when the